Right, I'm gonna close the waiting room and let them in. We've got 42.
Okay.
Hello, hello, hello.
My birthday.
I have just muted everybody. Sophia, that does include you, so you might want to take yourself off mute.
Thank you.
Righty. Hi, everybody. Happy Tuesday. I'm just gonna let people trickle in for a little bit. I've actually never had this many people in a Zoom room before, so I'm just gonna wait a couple of minutes and let people get in and get settled. I am just popping people on mute when they come in. Please don't take it personally. Let's have a look. Alrighty. Okay, we're up to 56. I'm going to give it until like 12:02 before we properly kick off. Sophia, I do have a tradition on my webinars, which is when we kick off, I always ask you what went well this week. So what's gone well for you this week? I feel like self-employed life is quite scary, so I'll always try and bring as much positivity as possible. So what went well for you this week?
Good question. So it's tax year end for us advisors at the moment. So what went well for me was around that. So I've managed to contact all of my clients and let them know their unused ISA and pension annual allowance ahead of it resetting on the 6th of April. So we'll talk about that in the presentation, but I'm just pleased that I've been able to get through everyone. And so they've got enough time to make a decision as to whether they want to top up their ISAs or pensions or not.
Love that. So they're all looking behind their sofas for some more money.
Exactly. How about you? What went well for you this week?
Oh, I spoke at QuickBooks Connect, which was really exciting. So my lean class went on before me and Tom Kerridge went on after me, which was a brain explode emoji moment. And tomorrow is the spring budget, which is always a crazy day in the life of an accountant. So I am working with BBC tomorrow to just get sort of all of those useful tax tips and live reaction to the budgets tomorrow, which is really exciting. Yeah, that's what went well for me. Okay, as promised, it is 12:02, so I'm just going to, if you get a notification on your screen saying I've muted you, it's not personal, it's just very loud because we're now up to 70 people in the Zoom room. So I firstly just wanted to kick off because this webinar has definitely been one of the most popular and most subscribed webinars we've ever had. I actually had to increase my Zoom license to be able to let everybody into the room today. So I'm very, very excited about that. Sorry if I mute you, just muted you. And yeah, this is actually a result of us bringing, I think, very on point content in front of you, regardless of whether you're a business owner, another accountant. I know there's lots of other accountants in the room, lots of our clients, lots of Sophia's clients, but also it's been an absolutely incredible cross-population of lots and lots of different people's audiences because we are British and talking about money is really hard. And I think webinars like this are a fantastic opportunity to bring up financial conversation, maybe with other people in your life, self-employed people, and even maybe to challenge you to bring it up in your own life as well. And so because there has been quite a large cross-population of our audience, I just wanted to kick off by saying hello. For anybody that doesn't know who I am, my name is Rachel. I am a disruptor in the accounting industry. I'm trying to change what it means to be an accountant, what it feels like to have an accountant, and what it looks like to grow and scale your own practice. When I first joined the accounting industry, things looked quite stale, pale and male. And as you can see by what's on this screen, that's absolutely not the case in my life. And I get to work with incredible brands across the country and actually across the world to just bring financial education into the lives of people who need it completely free, like webinars like this, which is why I've been really excited to collaborate with Sophia today. We're not related, for anybody who asks, we're just both blonde females. And I actually just wanted to, before we get kicks off. Sophia is going to share a QR code for her social media online. I've got a QR code on the screen now, so if you are joining us on your laptop, the very best way to say thank you for us being able to put insanely valuable, completely free consumable content inside your life is actually to talk about what we do today online. Say thank you to me and Sophia for doing this, and actually the increase in engagement and audience that we receive as a result of doing this, as well as all of the warm and fuzzy feelings, actually makes all of it worth it. And so the very, very best way to say thank you to us for creating this content for you is to talk about it, share it, and just shout about it as much as possible. And so I am very, very excited to introduce you to Sophia. Just a little bit of housekeeping. The meeting is being recorded. The meeting is being recorded today. I am just going to change my view onto speaker view for Sophia. So the meeting is being recorded. I'm now handing over to Sophia, who I can see your screen, Sophia, just before you panic and ask me if I can. And then also, please do pop all of your questions in the chat. I'm going to be collecting all of the questions. Sophia is going to be answering as many as possible in the Q&A session at the end of the webinar, and anything that we don't have time for, we are actually going to go away, bundle together, and create some post-meeting resources for all of you. So if you do have a question and it doesn't get answered today, don't panic. We will pull together some resources and make this as consumable and easy for you as possible. So I'm officially going to hand over to Sophia.
Thank you, Rachel, and thanks so much to everyone that's joined the call today. Honestly, Rachel and I have just been blown away by how many registrations there's been, and we had no idea that everybody was so interested on how to save tax, but really pleased that you are, because it is so important. So obviously I will be covering that. That's a big topic, but I also will be covering how I approach a financial plan for my clients, because you can really apply this to your own personal finances, but also your business finances as well, because I know a lot of you on the call will be either self-employed, sole traders, or limited company owners. So we'll go through all of those different options. Before we get into it, I just thought I'd do a quick introduction for those who do not know me. So I am a financial advisor. It's the same thing as a wealth manager or financial planner. We just like to make it confusing in this industry and call us all different names, but we all do the same job. But really what I do is I help business owners make smart decisions with their profit and help them extract money out of their business tax efficiently. So that's what I'll be talking to you about today. I am self-employed. A lot of financial advisors are self-employed, and we choose to align ourselves with a wealth management company. So I've chosen to align my own business with Brazil Wealth Management, which is part of St. James's Place, which is the largest wealth manager in the UK. And I always say to my clients, it feels like I'm giving them the best of both worlds, because I can give them that personal one-on-one service, but I'm backed by the credibility of a FTSE 100 organisation. I've been in financial services for about 10 years, and I retrained as a financial advisor during lockdown. And there were three main reasons why I chose to do that. So number one is to reduce the gender wealth gap. We have a big gender wealth gap problem in this country. It's not unique to the UK, it is global. But in the UK, on average, I tend to see women at retirement age have pensions around half the size of men. And not only is that a problem in terms of being able to enjoy a comfortable retirement, but it's also a problem because women actually statistically live longer. So we actually need bigger pensions in order to sustain ourselves. So I really want to help more women build up their wealth, particularly their pension pots, so that we can start to reduce this problem. The second reason why I'm a financial planner is to provide society with free financial advice and education. So I think it's crazy that we're not taught these things at school. And that's why I started my Instagram page, which you can follow. You can see mine and Rachel's at the top there. Just really to provide free financial education to society, because I think we should all learn these skills and know how to build wealth, but particularly today in terms of being a business owner, save on tax and use the other products available to you. And then the third reason is to have a work-life balance, and I hopefully will have a family one day. Now, when I was working previously in big corporations, I, like many people, was working long hours and didn't have such a good work-life balance. So now I'm a self-employed financial advisor. I hope to create that for myself, and I was living in Dubai when I was working in big corporates. I moved back to the UK because of COVID, and now I live in Henley-on-Thames with my fiance because we're getting married in September, and my dog Bailey, who you can see in that photo here. So before I get into it, I really want to talk about insurance. And before you all switch off, insurance is actually really important because I often ask my clients, what is your most valuable asset? And people might say it's their house or their car. It's actually you. It's your ability to generate an income. So particularly if you're a business owner or self-employed, if something happened to you, you know, what would happen to your business? And I know it's not a nice conversation to have, but it's really the prerequisite to a solid financial plan. And the key areas of insurance that I would advise you to have a look at is, you know, what would happen if you were no longer here? Particularly if you're the main breadwinner or you have a mortgage and children, you know, do you have a life insurance policy that would pay out a lump sum to cover that in that situation? You know, we're actually much more likely to get ill though than we are to no longer be here. And so making sure you've got the right insurance in place to cover you if you were off for a period of time because of sickness or injury, or, you know, would you go down to statutory sick pay, which for most people isn't enough to sustain their life and pay their bills and mortgage. You know, if your business relies on you for profit as well, you're the founder or CEO, it might be worth considering key person risk insurance. So I always use the analogy of creating a financial plan without having the right insurance in place is essentially the same as building your house on sand. So it's really important to make sure you've got the right insurance in place. And I've put a QR code in here that you can scan and just fill in sort of some information. I can contact you after this call if you'd like to know some more information on the types of insurance that are available, but also most importantly, the price and the quotes and what that would offer you. So I do recommend doing that. Before I get into how to save tax, which is why we're all here today, I just want to talk to you about my 5 steps to financial freedom, because this really applies to your personal finances, but your business finances as well. And it will all lead into the next stage, which is how to save on tax. So the first step that I talk to my clients about when they come to see me is step 1 of the financial plan. And that's, do you have control over your day-to-day finances? Now, if you've got any personal loans or high interest debt, I'd recommend paying that off first. But let's say you don't have that and you've got your income coming in, that might be through dividend, salary, you know, however you're choosing to pay yourself, and then you've got your expenses going out. This is really the first stage, which is getting your income higher than your expenses. And I love the fintech apps out there, which really help with budgeting, like Revolut and Monzo. So once you've got excess income, you've done a great job, and you can move on to step 2 of your financial plan, which essentially is financial security. The question to ask yourself is, can you absorb an unexpected financial shock? So if your income suddenly stopped for a few months, you know, what would happen? This is really why you want to build up an emergency fund. And that's a fund that you keep in cash. So it's not invested. And the emergency fund is there for you to dip into if for whatever reason your income stopped, as I said, for a period of time. It just gives you enough months ahead so you can keep paying your bills, keep paying your mortgage if you have one, keep your business afloat, you know, whilst you find alternative sources of income. So really focus on building that emergency fund. Once you've done that and you've got excess cash, you've done a really good job, and you can move on to step 3 of your financial plan, which is, are you free to choose to enjoy different areas of your life today? So this is when sinking funds come in. Again, I'd recommend these be kept in cash. So for me, as I said, I'm getting married in Portugal. Weddings are very expensive, and I underestimated how expensive they are. So a lot of my excess income has been going into building up my wedding pot. But for other clients I meet, you know, they might have a holiday pot, they might have a house deposit, or if it's your business, it might be, you know, a project you want to invest in. So just making sure that you're building up those different pots. Once you've done that and you've got your emergency fund, you've got your different pots for any upcoming costs on the horizon, that's when you can potentially start thinking about investing and move on to step 4 of your financial plan. This is really where I come in as a financial advisor. So people ask me, what do you do? And I essentially help people invest their excess income and excess cash into wealth. And that's so that they can free to choose to enjoy different areas of their life in the future. So for example, with investments, the goal of investing is to protect your money from being eroded by inflation. We've still got inflation at really high levels in the UK. We are seeing signs it's starting to come down, but on average, let's say it's at 10%. people often see cash as a risk-free place to hold money. This includes the cash in your bank account, but let's say you're earning 2% interest on that cash and inflation is at 10%, that's not risk-free. You've got inflation risk there because inflation is actually eroding the value of your cash by 8%. So really important to think about that, and investing is one of the best ways you can protect your money from inflation, but also you want to grow your wealth. That's why you're taking that risk by investing into the market. And so a few things to think about when it comes to investing, but number one is the time horizon. So I only recommend investing money you don't need to access for at least 5 years. Number two, investing in a portfolio that's suitable to the level of volatility that you're comfortable with and your preferences. A lot of my clients have sustainable preferences, for example. They only want to invest into ethical companies. And number three is making sure you've got enough in cash for emergencies so that you don't have to dip into your investments if you need to. And the three key sort of areas of investments that I tend to talk to clients about is their main residence, that's property, pension, which we're going to be talking about today, and stocks and shares ISA that we're going to be talking about today as well. And then these are the three goals as to why they're doing these products. So security of your own home, comfortable retirement, and using your stocks and shares ISA or other investments to help you generate an additional income in the future. So we'll talk about how we can do that. The final stage of a financial plan, which is just worth mentioning, is lifestyle inflation. So I've been guilty of this before, and it's essentially where you start earning more, which is great, but then you start spending more as well. And that's really when inflation can start to erode the value of your wealth, because instead of investing more, you're spending more. So just be aware of this. Okay, so we're on to the main topic, which is tax year end tips. And tax year end is on the 5th of April. It's on the 5th of April every single year. So the new tax year will start on the 6th of April. And there's just a few things to be aware of. So if we just look at the lighter box to begin with, just to discuss what your allowances are this tax year. So they will reset on the 6th of April or change. So firstly, it's your ISA. So the government gives us all £20,000 every tax year to keep in an ISA. Now, ISA stands for Individual Savings Account, and there's a number of different ISAs you can have. I'm going to talk about two main ones today, which is your cash ISA and your stocks and shares ISA. So your cash ISA is essentially protecting your cash from being taxed. Now, what I mean by that is when you earn above a certain interest rate and you've got you're over your personal allowance, your interest on your cash is subject to tax. So if you're a basic rate taxpayer, you can earn up to £1,000 in interest on your cash, and then anything above that you have to declare on your tax return, and it will be a 20% income tax charge. If you're a higher rate taxpayer, that falls to £500 before you have to pay 40% income tax on interest earned. And if you're an additional rate taxpayer, you don't have any personal allowance, so you have to pay 45% income tax on your interest earned. So the benefit of the cash ISA is that all of your interest growth will be tax-free, which is really good. Now, if you've got enough in cash already and you've got your emergency fund and your sinking funds and you're happy to invest in a suitable portfolio according to your risk appetite and for at least 5 years, it might be worth thinking about stocks and shares ISA. And that's because the stocks and shares ISA will also protect your money from tax, but it will, instead of be cash, it will be invested into the market. So that investment growth will be tax-free. And when you take it out in the future, it will all be tax-free as well. So as I said, you get £20,000 every tax year to use across your ISAs. If you're not yet in a position to invest in a stocks and shares ISA, but you think that's something that you would like to do in the future so that you can benefit from the tax-free growth, I recommend opening an easy access cash ISA this tax year, assuming you haven't already opened one, because by that it means it's easy access. So if you do need to access your cash for whatever reason, you can, but if you don't, you can then transfer it to stocks and shares ISA in future tax years without using up any of that tax year's ISA allowance. So that's my tip to do until the 5th of April when it all resets. Now, moving on to pension. You can invest up to 100% of your UK relevant earnings, up to 40,000, into your pension every tax year. Now, when you're a particularly high earner, thinking above 200,000 here, then it is worth seeking advice because you might be restricted on how much you can put into your pension. But let's base it on the up to 40,000. And I'll talk to you shortly about why I love pensions and why it's a really good way of saving on tax. But just be aware of your allowances. Now, that 40,000 allowance, that includes if you're enrolled in a workplace pension, I know most people here aren't employed, they're self-employed or business owners, but it includes any employer contribution and it also includes any tax relief. Currently, in this tax year, you can earn £2,000 in your dividends before you pay any tax. And you can also earn £12,300 in investment gains. So that's investments outside of an ISA. That could include buy-to-let portfolio. It could include investments in a general investment account or a fund and share account, for example. Now, the government have chosen to reduce those allowances going into next tax year. So you can see that's in the middle square on my slide. The dividend allowance is being cut on the 6th of April from £2,000 to £1,000, and then it's going down to £500 the following tax year. If you have not yet taken dividends from your business, your limited company this tax year, I would advise to take your full £2,000 allowance before it goes down to £1,000 next tax year. So that's something to be aware of. The investment gains as well is also being reduced from £12,300 this tax year to £6,000 next tax year, and then it's going down to £3,000 the following tax year. So that's why it's so important to be using up your ISA allowance, because it's all tax-free. Whereas investments outside of an ISA, it is more likely that more people will be paying tax on those gains if they sell them, because the allowances are being reduced. Now, I also wanted to talk about the tax rates as well and the changes that are going to happen on the 6th of April. So the dividend tax and national insurance tax is staying the same, but the corporation tax is increasing from 19% to 25% at a marginal rate when your profits are above 50,000. So in terms of getting advice on this area, this is what Rachel and StriveX are there for. They can help you in terms of, working out potential tax rates. But there are ways to mitigate corporation tax that I'll talk to you about today. And that's really important, particularly with the tax rate going up. And unfortunately, more people are going to be earning above the now new additional rate threshold of 125,140. So that will be 45% income tax above that now. Now, it's a good problem to have, I know, if you're earning that sort of level of income. But what's important for you to be aware of is there are ways to mitigate it, and also to be aware that any cash you're keeping in your bank account, the interest earned is subject to 45% income tax. So again, that's where a cash ISA can come in. And I also just want to give a shout out to premium bonds here, because I've just moved my emergency fund into premium bonds because they are 100% secure. So it's backed by the UK government. But instead of your money being in a bank account, it's kept in premium bonds. Now, don't let the name put you off. It's essentially still cash. The probability of winning, so the government will enter you into a prize draw every month by keeping premium bonds. You can win £25 all the way up to £1 million. Now, great if you become a millionaire, but even better, those winnings are tax-free. And the probability of winning is equivalent to an interest rate of 3.3%, which is one of the best easy access rates that I've come across in the market. So particularly if you're a higher additional rate taxpayer and you think you're over those thresholds in terms of what you can earn in cash in your bank account, premium bonds are a good place to keep cash because it's tax-free, but also in terms of keeping your emergency fund there because it's out of sight, out of mind. A caveat is that it can take up to 2 weeks to take premium bonds out. Normally it's 3 working days. There's no charge, there's no exit fee, there's no cost to hold them, but always have enough money in your bank account for day-to-day expenses as well. Okay, we are going to move on to probably the best slide in this presentation, which is how to save tax. Now, this is really where pensions are your best friend. And if you don't have a pension, this is your sign to really consider getting one because it is so important. Regardless of what age you are, pensions are, I think, one of the best ways to save tax, but also help you save for a comfortable retirement. So I'm going to talk about 2 different routes here. The first is sole trader. So this is what I am, self-employed. And by moving money out of my business account into my pension pot, automatically you get 20% tax relief added on. So the money that you put into your pension will automatically get an extra 20% added onto it. And that's because you can claim back your basic rate income tax relief. So if you put £10,000 into your pension, £12,500 will actually be invested, and that's amazing. Even better, if you're a higher rate or additional rate taxpayer, when you do your tax return, you can write on your tax return your gross contribution into your pension. So that would be, in this scenario, 12,500. Now, assuming you've earned that in tax, you may be able to claim back an additional 20% or 25% on that pension contribution. So in this scenario, that would be a tax refund from HMRC straight into your bank account of 2,500 or 3,125. So this is why I think pensions are so good in terms of being able to claim back your full income tax rate and getting that tax refund, which is always nice to have. Now, sensible financial planning, if you don't need the cash, I would recommend to clients to reinvest that tax refund back into their stocks and shares ISA, if they have one, but you can just keep it or use it to go on holiday, do whatever you want with it. Now, if you're a limited company owner, one of the best ways to extract money out of your business tax-free is to put it directly into your pension. So any money you extract from your business into your pension is tax-free. So that's great. Even better, you can reduce your corporation tax bill down. And with this going up from 19% to 25%, this is going to be really important going forwards. So again, this is where Rachel and her amazing team at StriveX Accountants can help you. But I just did a quick scenario to show you how this would work. So let's say StriveX Accountants have calculated that your profit is £10,000 for the tax year, and your corporation tax is 19%, so that's 1,900. What you could do is make a pension contribution equivalent to the profit, say £10,000, and therefore you've reduced your corporation tax bill down, because pension contributions should be treated as an allowable expense if you're within the HMRC rules, and therefore you can reduce your profit and reduce your corporation tax while saving for a comfortable retirement as well. So this is the best way to save tax, is either sole trader through your pension, you get that tax relief, you get the tax refund if you're a higher or additional rate taxpayer and you've earned that in tax, or you're a limited company owner and you can extract money out of your business tax-free and reduce your corporation tax bill. It really is a no-brainer. A question I get a lot is, Sophia, that sounds great, and I understand the benefits of investing into a pension, but I've got income needs today, and it's not until ages away that I'm going to retire. And I completely appreciate that it has to be affordable. So anything you're putting into your pension has to be affordable in terms of what you put in, you cannot get out until retirement age. Now, currently, to get access to private pension, the earliest you can do that is 55. That is going up to 57, and then it's likely going to go up to 58. And that's because state pension age is now at 68. So the age that you can access your private pension is normally 10 years below state pension age. But there is a cost of delay. So for every year you delay putting money into your pension, it will affect the size of your pension pot if you keep the same level of contribution going forward and you don't increase it. So I've used the example here of Kate and Ben, and I'll walk you through it. So Kate, she starts investing into her pension at 25. She invests £700 every single month for 20 years, and then she stops altogether at 45. So she stops investing into her pension. Assuming a 6% investment return, her pension could be worth, nothing's guaranteed, but it could be worth just over £1 million at 65. So she's actually hit her lifetime allowance of what she can invest into her pension. That would produce a sustainable income based on a 4% yield. And again, I recommend seeking advice of around £43,000 a year. So great. I mean, she's going to be on track for a very comfortable retirement. Ben starts at 35, so only 10 years later than Kate, and he invests £700 every single month for 30 years. So he actually invests for an extra 10 years than Kate, and he stops investing at 65. Now, his pension's still good, really good, 703,000, producing a sustainable income based on a 4% yield of 28,000 a year, but not as good as Kate. And you can see that's because Kate started 10 years earlier. Now, the reason this is the case is because of something called compound interest, which Albert Einstein actually referred to as the eighth wonder of the world. And if you're a bit of a finance geek like me, then you'll see why. But it's because money starts to make money. So I always use the analogy of when you're creating a snowman and you use you're creating a snowball and you sort of roll it down the hill and it gets bigger and bigger. It's the same with investing. So the earlier you start and the longer you invest in the market, the more likely you are to achieve the returns that you want and also grow the size of your portfolio. And finally, before we get on to the Q&A, and I know there's lots of questions coming through, which is great, I just wanted to share this page with you because this is an extract from my favorite book called Rich Dad, Poor Dad. And if you haven't read it, I really recommend you buying it. It's such a good read. And essentially the ethos is that you want to use your income to start buying and investing into more assets to produce more income. So if you look at the income statement and balance sheet on the left-hand side, this is typically what we all do and what we're guilty of, where we get our income, whether that's through, you know, dividend, salary, or employment, and we've got all our expenses going out, but we use the income to buy liabilities. So that might be your loan on your car, it might be the mortgage on your house, it might be credit card debt, student loan, and you end up in this cycle of just your income coming in every month and it going out on your liabilities, so that's your debt. And then you can see on the expenses here, you've got your taxes, mortgage payment, car payment, etc. Now, this is really normal. And, you know, we all experience this. What I'm encouraging my clients to do is using more of their income to really build up their assets. So you can see that on the right-hand side is that, yes, we've got our liabilities, you know, we've got our mortgage, got our credit card, etc. But building up your assets, so building up your stocks and shares ISA, building up your pension, that is how wealth is created. And then in the future, you might be able to generate an income from those investments. So again, I've used the example of Kate and Ben. So let's just say Kate and Ben invest £20,000 each into their stocks and shares ISAs for 10 years at 6% investment return. Now, I appreciate that's a lot that they're going in every single year. 20,000 is a lot, but this is just for illustration purposes. In 10 years' time, their total investments could be worth around 530,000. Now, because it's all in their stocks and shares ISA, all of those investments are tax-free. The tax-free growth, and also then when they take it out, is tax-free income or tax-free gain. So let's just say they came to me and they said, okay, Sophia, I've got 530,000 in my stocks and shares ISA. I really want to generate an extra income from my investments because we want to, you know, we've got childcare costs, for example, and we all know those that have children, the cost of nursery in this country is very expensive. So they might say, you know, we want to produce an extra income from our investments. What I would then do is help them invest into a portfolio of dividend paying companies. And normally we can produce a yield of about 4%, depending on the portfolio that they're invested in. And in this example, that would produce an extra income for them, and it's tax-free income because it's all in their stocks and shares ISA of £21,000 a year. And their 530,000 remains invested. So yes, there'll be some times that, you know, we have to erode the capital a little bit. It will be going up and down with the market, but they're getting that additional income from their investments. That's why, again, I love stocks and shares ISAs. So thank you very much for listening to me and talking about how to save you tax and also going through the different aspects of your financial plan. I wanted to leave a lot of time for Q&A because I know there's lots of questions. So please do ask your questions in the chat and I will aim to get through as many as possible. As Rachel said, we will follow up anyway with any questions that we weren't able to answer with more resources. And I put both our QR codes in here as well so that you can follow us on social media and also book in some time with me if you'd like to learn more information, both on insurance, which is so important, but also on your own, you know, financial and business plan as well, and talking about how to save you tax.
Perfect. So one question I can actually answer. So somebody asked, is there any reason why you would be restricted from putting company money into a premium bond rather than personal money? That's a question that lots of people are asking at the moment because of a lot of the banking uncertainty, especially with what's happening in the US. But unfortunately, premium bonds are actually only open to individuals in the UK. So only individuals can buy premium bonds, companies can't. Next question is for Sophia, which is, can you move funds into a cash ISA? Can you move funds in a cash ISA into a stocks and shares ISA without removing it from its wrapper?
Yes, exactly. And that is why I'm recommending, if you're not in a position to start investing yet, because you're still building up your cash reserves, one option could be to open an easy access cash ISA. So you're not locking it away, it's not a fixed rate cash ISA, so you can still dip into it if you need to, but in the future you could transfer it to a stocks and shares ISA without you losing that ISA wrapper. And you don't want to lose that ISA wrapper because that's what's protecting it from the taxman. And it means that when you do transfer it in the future, you're also not using any of the future tax year's £20,000 allowance.
Alrighty, somebody else has said, are there any tax allowance benefits for employed individuals?
Yes, so employed individuals still have access to their stocks and shares ISA, which is great. So anyone, and going back to Rachel's point on sort of the premium bonds, stocks and shares ISA, the ISA stands for individual savings account, so it has to be under an individual's name as well. But an employed individual, sole trader, limited company owner, anyone can open a stocks and shares ISA. And as long as you're over 18, if you're under 18, there's also something called a junior stocks and shares ISA, which I haven't touched on, but they do exist, and that's great for children, but also your pension as well. So a lot of my clients will have their workplace pension scheme, which is always worth staying enrolled in, because thanks to auto enrollment that came in, if you're above a certain threshold, you'll be getting on minimum 3% contribution from your employer each month into your pension and 5% from your salary. So that's really good. But most of my clients will have a private pension on the side as well. And that's really because lots of people change jobs throughout their career and end up having multiple pension schemes. I've had people come to me later on who've got over 10 different pension pots. It's very difficult to put a retirement plan in place if you've got so many different pension pots, because you don't know where it's invested, what sort of income it's going to generate, whether you can even access your income at retirement and what that looks like, or whether you have to move it to a different product. It starts to get very complicated. So again, I would seek advice before you consolidated your pensions, because there might be reasons why you shouldn't move out of your pension scheme. So I would look, for example, if I was doing this for a client, I would look to see if there was any exit charges or any benefits that they might lose if they move out of their pension scheme, like protected tax-free cash. But let's just say I've done all my research and actually I think it's in their best interest to consolidate their pensions, then we can move it into a private pension. And then when it comes into handy in terms of thinking about your tax allowances, is then looking at, okay, you've got that up to £40,000 for most people every tax year that they can put into their pensions. They can be doing that through their workplace pension and benefiting from no income tax and no national insurance tax, because you get tax relief at source by putting it into your workplace pension. But particularly if you're a higher or additional rate taxpayer, that's why people like to have the private pension as well, because as long as they stay within their annual allowance, they can make an additional top up into their private pension in order to be able to claim back their income tax and get that tax refund.
Perfect. The next question is, I'm a sole trader. I'm going to be making a profit this year and hitting the taxable allowance threshold, which they put in brackets, which I believe is £12,500. If I take anything above the allowance and add it to my pension or open an easy access ISA, would that mean I won't be subject to tax this year? Do you want me to answer that one?
Yes.
Yeah, so as a sole trader, everything that you make in profit is subject to income tax. However, if after that you then decide to put it into a pension, there's not any further tax relief. So as a sole trader or a limited company, we have to pay tax on all of our profits, irrespective, especially for sole traders, if you're putting that into a pension. However, if you're anticipating the business growing and scaling and you're incorporating a limited company, there are quite a lot of tax benefits to contributing to a pension, which are for the business tax deductible as well. But as a sole trader, you need to pay profit on the tax before that then goes into a pension. Somebody has asked, for a limited company, does it have to be a specific business easy access cash ISA rather than a personal one you've already got set up?
So the cash ISA would be your personal one because it's an individual savings account. So with your business account, it is worth always seeing what the best rates are in terms of the bank that you're with, in terms of your business. So always making sure you're getting high interest rates. But in terms of a cash ISA, that would be your individual cash ISA. And as I said, easy access if you want to be able to access it quickly. But if you can lock the money away for a period of time, then it tends to be higher rates. But just be aware of the T's and C's if you need to extract the money out before the maturity date.
Perfect. I'm having to scroll in between all of the compliments saying how easy, clear and reassuring you made it to find the questions. So I would encourage people, we have got a little bit more time left and we're on the last question. So if anybody does have any questions, now is the time. The last question is, can I save into a help to buy and a normal cash ISA at the same time?
Yes, you can. So your £20,000 allowance is across all of your ISA products. So it's just something to be aware of. And another question I get a lot is around, well, can I open two types of the same ISA in every in a specific tax year? And you can't. So you can open a help to buy ISA, a cash ISA and a stocks and shares ISA, but you can't open two of the same types. So that's just something to keep in mind.
Perfect. Sorry, I did just realize there was another question and I was about to post something in the chat. So at SthriveX, my accountancy practice, we offer accounting services for individuals and limited companies, and we now also offer mortgage advice, specializing on working with small business owners, but to everybody. So we offer mortgage advice, and then we also offer insurances as well. So if lots of these conversations around insurances, you'd like to have a conversation, you can book in with me, but I think people can also talk to you about insurances too, right?
Yes, exactly. So if you scan the QR code, you can choose what you'd like to talk to me about, whether it's a free financial planning chat, whether it's tax year end dependent. So I do have space to see you before tax year end, hopefully, and that is fast approaching, but also talk to you about your insurance options as well.
We have just had a flurry of like 7 questions come in. So Natalie has asked, can my limited company pay into my previous workplace pension from my old employed job, or does it need to be a separate personal pension?
It depends. So some workplace pensions will allow you to be able to make additional contributions, but some don't. So that's why I advise, if you're not sure, working with a financial advisor you can find out for you, or you can contact your pension provider and ask that question. If they can't, then it might be worth exploring the option of potentially transferring out of your old workplace scheme into a private pension that you can then make additional contributions in from your limited company. But again, I would seek advice before you do that, because there might be reasons that you shouldn't move out of your old workplace pension scheme.
Perfect. Don, who's a client of ours, has said, is £40,000 the max I can pay into my pension as a limited company owner?
Yes. So as a director of your business, you can invest up to £40,000 every tax year into your pension. And that's why it's great, because when I see my clients who are business owners and they've got excess cash in their business, so they've got enough to meet cash flow and any upcoming cost, it's one of the best ways to extract money out of your business tax-free and help you save for a comfortable retirement. Now, if you're in a fortunate position whereby you've got more than 40,000 excess cash in your business account and you really want to bump up your pension and help save corporation tax, you can use something called the carry forward rule. Now, again, this is when I would recommend seeking financial advice. But in certain situations, we can go back your previous 3 tax years and use unused pension annual allowance as well, assuming you've been enrolled in a pension scheme, a UK pension scheme for that time.
Perfect. Kind of similar question from Charlotte next is, and I think this might be a combination of the two of us, if I put all of my profits from a limited company into a pension, in brackets, I'm also on PAYE, so I don't need the limited company money to live off, will I pay 0 tax, or is it still taxable because it's profit? So when we extract profit from a limited company over to your pension scheme, that is tax deductible for corporation tax purposes. So as long as you've got less than 40,000 or 40,000 or less in taxable profits in a limited company, and we extract that into a personal pension, you won't pay any corporation tax. Yes, that is correct.
Yeah, it's amazing when together we're able to save our clients corporation tax and help increase the size of their pension pot.
Tamsin's asked, what happens when you reach an age where your pension contribution can't catch up with someone in their 30s?
It's never too late, because you can make additional contributions into your pension, up until the point you start drawing your pension, and then there might be restrictions in place. But as long as you're within your annual allowance, I do recommend investing into your pension as much as you possibly can, because particularly for wanting to achieve a comfortable retirement, but also wanting to save on tax. So as I said, if it's through your employer scheme, you save on income tax and national insurance tax. If it's through your own contribution if you're self-employed, then you save on income tax. And if it's through a limited company, you save on corporation tax. So it's always worth doing regardless.
Amazing. Oh, to be fair, this is a common question. So Chris has said, sorry, can you briefly explain again how you can get 20% tax relief on your pensions, e.g., which section of your money is given the tax relief?
Yes, good question. So your pension provider, whoever you choose to set up a pension with, if it was through me, then I would do this automatically for you. They'll automatically be adding on 20% tax relief to your pension contributions, because you can claim back your basic rate income tax relief straight away. So that's your basic rate income tax. That's why you're getting that 20% contribution. So £10,000 into your pension, if it's coming from a personal contribution or as a sole trader, self-employed individual, then because you've already paid tax on that money, then you can claim back your basic rate income tax, which is a 20%. Now, if you're a higher or additional rate taxpayer, and assuming you've earned that in tax, you can likely then claim back an additional 20 or 25% as well. And that's when you get the tax refund from HMRC.
Yeah. And if you compare that to somebody who's in employment, pension contributions are so tax efficient because pension contributions are taken from your gross wages, not your net wages. And so this is just the way that we add that back for self-employed people so that you still get all of the benefit that people who are employed do. This is a really common question, which I know you've been asked before, because I think I've seen you get asked this before, is how much do you need to be earning to make it worthwhile working with a financial advisor?
Yes, it's a really good question. And there's not one answer to it, to be honest, because each financial advisor will have their own sort of minimum investment amounts in place. I tend to talk about it in terms of what are the level of services that you require. So if you're starting out on your investment journey or your pension journey, then it might be worthwhile, doing it yourself. That's going to be the cheapest option. But if you require sort of more specialist advice, either because you're a business owner or limited company owner, you want to stay within your allowances, you might be a higher additional rate taxpayer and you want help with your tax refund as well. Also, or if you just want somebody to sort of keep you accountable every year, because I meet my clients every single year, we go through an in-depth annual review meeting, talk about their entire financial plan. A lot of people don't have the time, inclination or knowledge to manage their own finances. So I really think everyone could benefit from a financial advisor, but different financial advisors will have different minimums in place.
The next question is, does the transfer from business account into pension have to occur before the end of the tax year, or can it be done while you're sorting out your end of year accounts in the months after?
So in order to be part of, in order to use your pension annual allowance, that has to be in that tax year to use that allowance from that tax year. But I guess it gets a question for you, Rachel, as well, around, because there's always a difference sometimes between company financial years and the tax year as well.
Yeah, and when in there would rollover relief?
Yeah, so the rollover relief, the carry forward rule, that is a bit, again, based on the tax year. So even when I'm calculating it for someone and they might have been doing a regular contribution into their pension, and one year it's the 1st of April and the another year it's the 7th of April, the date that it goes in is the date at which we calculate that allowance for that tax year. So just always think it should be based on the tax year when you're using your allowances, which are based on tax year rules.
Yeah, so it's worth saying that if you have a limited company and your limited company year end date does not align with the personal tax year, and you actually have quite a significant amount of excess profits to extract, you could extract, if your limited company year end was the 28th of February, you could extract part of your pension, 40k, within the tax year that fell into the 28th of February. And then after the tax year end goes in the next financial year, you could do another lot of 40, as long as they're in separate tax years. They can be, I'm pretty sure they can be within the same accounting year for accounting purposes. And
this is why it's such a good time as well, because you're on the cusp of a tax year. So you could be doing 20,000 this tax year into your stocks and shares ISA, and 20,000 next tax year into whatever ISA it is, but also 40,000 into your pension as well over the 2 tax years.
Perfect. Alrighty. We had an interesting one. I don't know how often you get compared to Martin Lewis, but I imagine people probably bring information.
I love Martin.
I would say you're prettier than Martin, but somebody said, I know Sophia talked about premium bonds being a really good idea, but I watched Martin Lewis on his show the other week and he didn't seem to think they were a good idea, so I'm unsure what to think. Do you have any further information about this that would help decide if they're a good idea?
Yes, so I'm quite keen on premium bonds because in the past, and this is why they get a bad reputation, in the past, grandparents often gave premium bonds to grandchildren and no one had any winnings. I mean, you were lucky if you had some, but it was kind of one of those products where you might get a cash in the check 20 years later for £25, and that's the first winning that you've had. Now, a cash in the check, I meant a check in the post. But now the government have increased the probability of winning. So as I said, it's equivalent to an interest rate of about 3.3%. That is the best, one of the best easy access rates I've come across. And it's particularly useful if you're over your allowance in terms of what you can earn in interest in cash. So if you're a higher additional rate taxpayer, particularly if you're an additional rate taxpayer and you don't have any allowance left, then premium bonds is a really good place to keep cash because it's all tax-free, and you might be using your ISA allowance elsewhere for your stocks and shares ISA. I don't know what Martin said about premium bonds, but one of the downside is that it can take up to 2 weeks to take your money out. So that's just something to be aware of. But also they're not invested. So it's not the same as investing. It's not going to keep up with inflation. It's just the same as keeping money in a bank account.
I would say as well, I really love premium bonds, mainly because I love the excitement every month of being like, am I a millionaire? I mean, I'm not, but am I? And I actually withdrew some premium bonds recently, and it took way less than 2 weeks. I think I originally got premium bonds when I was about 17, and it was all paper-based, and you had to fill in a form and send it back, and it was very slow. And actually that was good for me at 17 because it was quite slow to access my money, which is what I needed. So it deterred me from accessing it, but it's all online now. It's all done by like faster payments, and you can actually already set up direct debit, so a percentage of your income or a fixed amount goes in every month, which I love. And from a nerdy tax perspective, the reason premium bonds are tax-free is because they count as winnings, and winnings, if you are playing games online or gambling, or in this case, entering into a lottery, winnings are actually completely tax-free. Naomi's actually asked, similar question to Amy, but about accounts. When does it become a good business move to work with an accountant? There's lots of different answers to this, but the most powerful answer I can give you, which is the truth, is when you want one. There's lots of different reasons and benefits and tax savings and all of the good stuff. Even like sessions like today, I think is a really great opportunity to showcase how valuable monetary and non-monetary having access to financial education is. Lots and lots of people work with an accountant to make sure they never miss a deadline, to tackle any financial anxiety that they have. I think for lots of us, we have quite a lot of emotions and feelings attached to finances. And so by working with somebody that you really love working with, it can help you tackle a lot of that stuff. And then also, we're not taught how to run businesses at school, but actually accountants kind of are. I'm an accountant who did my accounting qualifications and actually then went on to do an MBA. And so I was taught at school how to help people do this stuff. And so having those people in your corner, whether that's, oh my gosh, let me introduce you to somebody who does the same thing as you in the same place, and I think you'll become best friends and have a great time doing it. For me, there's lots and lots of different reasons why you would get an accountant, but the most important when you should get an accountant is when you feel like you want one or you need one. And actually, lots of different accountants work in different ways. Our clients, we only bill on completion of the work, so we can have a relationship that for most people is about a year long before they ever have to pay us. And we do that intentionally to get more people in front of financial education who need it the most and might actually not at the point that they need it be able to afford it. So, Sophia, what's the easiest way to work with you?
The best way to work with me is to reach out for a free initial chat to begin with. So again, if you could scan the QR code and just fill in your details, I'll get in touch with you and you can say what, some more information as to what you might like help with. And then we just have a free initial chat. And so we just go through your financial situation, any concerns that you've got, but most importantly, your goals. So, you might want to focus on retirement planning. You might want to focus on how to save tax. You might want to focus on extracting money out of your business tax efficiently. Or, it might be areas like you might have children and you might want to focus on providing them financial security for the future. That's something that I'm really passionate about, is helping children with child pensions. I signed up my youngest client of 3 weeks old recently with a child pension, which was amazing, and junior stocks and shares ISA. So really it's the full suite of services, and then we'd go through it, see how I can help you. And if I feel like I can help you and you'd like to work with me, then we would onboard you as a client. And as I said, if you do work with me, we'd meet at least once a year for an annual review meeting where we have an in-depth conversation. I'll be nudging you as well throughout the year, letting you know about your tax-free allowances, tax year end, any sort of new fun backs that I come across. I'm always keeping an eye on the best interest rates in the market and other products that come out as well. But I'm around as your dedicated financial advisor. So whenever you've got any questions, I'm really here to reach out to.
Amazing. Cool. There's no more questions in the chat, just lots and lots of thank you recommendations from people who already work with Sophia. I hope it's come across as clearly as it is to me and Sophia that actually both being young females in finance, we actually fundamentally really, really like each other and are very good friends. And so it's actually just a great way for us to work together and support more people doing what we love together. But the chat is popping off with so many people saying thank you. Cool.
Well, thank you to everyone as well, because I honestly, as I said at the beginning, blown away by how many people have joined this conversation. And Rachel and I were saying just before, we launched this webinar, that it's great to see so many more people interested in wanting to, grow their business and do the right things and work with an accountant, but also think about their financial plan as well. So yeah, hats off to you all for joining today.
Amazing. As I did say at the beginning, the very, very, very best way to say thank you to us for delivering this information are Gian, who is a shared client of both of ours, just said highly recommend working with both. I'll pay you later for saying that. Thank you so much. And yeah, the very best way to say thank you to us for delivering this content is to just say all of those lovely things that you have been saying in the chat online and tagging us in it. We have the best jobs in the world because we get to work with everybody like you all day, every day. And actually by creating this content, it gives us the opportunity to do more of that. So thank you so much. I'll let everybody get back to work or get back to lunch, and we'll see you all again very soon. But thank you so much. Bye, everybody.
Bye. Thank you.